SMCI is facing a simple but dangerous question: is this the beginning of a breakout, or the start of a breakdown? Hi everyone, welcome to Stock Market Breakdown. Today we're talking about a company that has become one of the most confusing and most debated names in the entire AI infrastructure space. This year's Supermicro, or SMCI. The stock is sitting around $33 right now, barely up year to date, barely up over the last 52 weeks. And honestly, if you just look at the chart, you never guess this company is supposed to be part of the AI boom. But the deeper you dig, the more you realize the next few quarters for Supermicro could actually be a major signal for the entire AI hardware cycle. Whether we keep pushing higher or lose momentum, let me put the core idea right at the front. Supermicro doesn't build the brains of AI, it builds the body. NVIDIA, AMD, Intel, those guys build the brains. Supermicro builds everything that makes those brains actually work. The servers, the racks, the wiring, the liquid cooling, the whole physical AI factory that turns chips into real compute. They're not selling parts, they're selling a ready-to-run system, and that's a huge advantage when a customer buys from Supermicro. They're not getting a bunch of components their engineers need to assemble, they're getting a fully wired, fully cooled, pre-tested setup that can be rolled into a data center and powered on immediately for training. In AI, deployment speed is everything. Whoever gets compute running first gets ahead. Supermicro wants to be the company that delivers that speed. But here's where things start to go sideways. Even though the story sounds great, the numbers don't. Last quarter, Supermicro pulled in around $5 billion in revenue. That's down 15% from the $5.9 billion they did a year ago. And gross margin, about 9%. That's the lowest in company history for a hardware company. 9% gross margin is basically driving with no brakes. Yes, you're moving, but the risk is huge. The more you sell, the less you keep. Wall Street sees that and immediately thinks, no pricing power. But then comes the twist. Management guides Q to revenue at $10 to $11 billion. That means revenue could double in one quarter. That's why this stock creates so much noise. Some investors think this is the next AI infrastructure monster. Others think it's the value trap wearing an AI badge. So naturally you ask, how do you go from $5 billion to $10 billion? And honestly, management didn't give a detailed explanation. They mentioned strong demand, higher capacity, faster AI factory shipments, but nothing concrete, which means if they hit a number, the stock gets repriced instantly. If they miss, well, it looks like overpromising. But the real key is this: it's not just about hitting $10 billion. It's about what happens to margins when they hit $10 billion. If gross margin stays at 9%, even doubling revenue won't change the story. They'll be scaling volume, not scaling profit. But if margins recover into double digits, closer to the 13% range from before, the whole narrative shifts. Now, let's look at why they might actually get there. First, their relationship with NVIDIA is extremely deep. Hopper, Blackwell, GB200. Supermicro is one of the earliest companies ready with full systems. Being early matters. When customers want Blackwell clusters, they want them now, not in 6 months. If you ship early, you win early. Second, they've added AMD GPU systems to their lineup that expands their total addressable market instantly. Some companies would choose AMD for cost or timing reasons, and now Supermicro can serve those customers too. Third, they created a dedicated federal entity to serve government agencies and government contracts. They're slow but extremely sticky. They run for years. They're stable. For a company like Supermicro, federal deals mean predictable revenue, even in down cycles. Fourth, they now ship pre-configured AI factory units that are essentially plug and run. Faster deployment means faster revenue recognition. Companies don't want to wait for compute, they want it immediately. Supermicro's whole pitch is speed, and that shows up in its revenue acceleration. Now let's talk risks. First, gross margin. 9% is not sustainable. If margins don't improve, the stock will not get a premium valuation. Period. Second, macro uncertainty, tariffs, tax changes, policy swings, all of that affects hardware companies directly. Third, analyst sentiment is neutral. About 19 analysts cover the stock. The consensus is basically hold, not bearish, not bullish, just cautious, but their highest price targets still imply over 90% upside. So clearly people see potential, but no one is confident enough to commit without seeing results. So here's the simplest way to understand Supermicro right now. This stock isn't about being cheap or expensive. It's a high uncertainty, high leverage bet on the next 2 quarters. You're not betting on the next decade. You're betting on the next 90 to 180 days. If they deliver 10 billion plus and margins rebound, the stock gets re-rated fast. If they miss, or margins keep falling, the stock stays stuck or drops lower. In my view, if you're building a position, you don't go all in. You scale in. Let the numbers decide your exposure, not the story. This stock moves finally. If you're wrong, it hurts. If you're right, it pays very well. It's investable, but only if you approach it carefully. Alright, that's our breakdown for today. If you've got thoughts on Supermicro, bullish, bearish, somewhere in between, let me know in the comments. And if the video helped you, hit that like button, subscribe to the channel, and stay tuned for our next deep dive. I'm Stock Market Breakdown. Thanks for watching, and I'll see you in the next one.